Hello, I'm Mark Dunn, the editor of investment magazine Portfolio Institutional. And for the next hour, I will be chairing a discussion on fixed income strategies that know no boundaries, known as multi-asset credits or MAC. Now, we're living in times of low interest rates and falling bond yields, not a great combination for the growing number of cash flow negative pension schemes we have in the UK. So could a MAC strategy where managers have a wider remit and more tools to employ be a way of generating greater returns? Now, I'm quite excited about this because this is a topic we haven't covered for a few years. So like everyone else, I want to know what's going on. And to help, we have assembled a group of insiders to discuss the markets. And before we start, let's meet them. Lloyd, could we start introductions with you?
Yeah, morning, everyone. Firstly, thank you, Mark, for the invite to the roundtable this morning. My name's Lloyd Thomas. I'm portfolio manager with Border to Coast. I head up their credit strategies on the external management team. My background is in absolute return, where I've managed multi-asset and flexible fixed income funds for the last 10 or 12 years. Some background on Border to Coast. It is the investment arm of a collection of local authority pension funds, which is a pooling exercise, of course, and they were set up around 3 years ago. We're in our transition period. So at the end of that phase, we'll be looking to have around 42 billion AUM.
Gotcha. Okay. Thank you, Lloyd. Good to have you on board. Tex.
Hi, everyone. I'm Tex Harding. I'm a director at ITS. So I'm a professional trustee across a range of schemes, mostly on the defined benefit side, but also some defined contribution and master trust as well. With my other hat on, I chair the APPT, that's the Association of Professional Pension Trustees Committee on ESG and Climate Change. Hate those acronyms.
Okay. Thank you, Tess. Thank you. Andrew.
Hi, Andrew Cole. I, like Tegs, also a professional trustee. And like Tegs, I also sit on the APPT's ESG working group. I work predominantly with defined benefit schemes and a couple of defined contribution schemes, mainly in the finance market, so the banking sector, which is where my background was, as I was previously global head of derivatives for an investment bank.
Thank you very much, Andrew. Thank you. Paul.
Yeah, good morning, everyone, and thank you to my fellow panelists for taking the time out today. So I'm Paul Whelan. I'm co-head of the Global Fixed Income Manager Research Team at Aon, based in London in the UK, where I'm responsible for devising strategies and recommending investment managers across the liquid and illiquid fixed income asset classes. Joined Aon in 2012, and prior to that had over a decade experience of actually managing fixed income strategies at external asset managers.
Thank you, Paul. Thank you, Paul. Philippa.
Yes, hi everyone. So I'm Philippa Allen and I'm a portfolio manager in Aon's fiduciary business. So I run 3 of our fixed income funds, including our multi-asset credit fund. And these funds are used for both our fiduciary clients and for non-fiduciary clients as well. One of my other sort of key responsibilities is I'm the lead on the responsible investment side within the portfolio management team. So really heavily involved in the development of our approach to responsible investment within our funds. I joined Aon about 2.5 years ago. Before that, I was at BT Funds Management in New Zealand. So I spent about 5 years there, primarily focusing on manager research within fixed income. But it was a reasonably small team. So I got involved in lots of different things across the whole investment process.
Thank you, Philippa. And finally, Alex.
Thanks. Well, good morning, everybody. So my name is Alex Denbraber. I'm a partner at Aon and have 2 roles. The first being as a lead consultant to a number of clients ranging in different sizes from tens of millions to several billions. So very varied in nature and governance requirements. My other role is the head of liquid credit content. So that is helping clients find solution across different liquid credit strategies, with multi-asset credit being an important one, particularly in this day and age. Thank you.
Okay. Alex, thank you very much for that. So thank you very much, guys. And actually, Alex, if we could just stick with you and we can open the questioning with you, could you just explain exactly what multi-asset credit means to you?
Yeah, so really, it's the clue is in the name of multi-asset credit. So it is a diversified credit solution, and really the managers will aim to capture different credit risk premiums investing across a range of securities, and that's different geographies, different sectors, all within the fixed income universe. They are predominantly long only from our experience, and unconstrained as well. And I think within that, I think we need to acknowledge there are a really wide range of solutions that exist with different risk and return profiles, benchmarks, and things like that. And while I work in liquid credit predominantly, there are also closed-ended, illiquid, and private solutions as well. So for me, investors will typically select multi-asset credit because they can see both through experience and through modeling, better risk-adjusted returns. And that's from the diversification you get across all those different credit markets. But also, if you think from a top-down perspective, a multi-asset credit manager can look to navigate through the different markets and sectors as that market cycle changes over time. And that gives the benefit of, not only managing risk, but exploiting some of the dislocations where other sort of single strategies would otherwise be constrained. So that's a sort of whistle-stop tour of my understanding of multi-asset credit.
Great. Thank you, Alex. I'm sure we can get to the crux of some of the points you made there. But first, Lloyd, you joined Board of the Coast a few months ago to establish a max strategy. I mean, how's that going at the moment?
Yeah, well, it's due to launch over the next, post-summer, so Q3, end of Q3. Okay, so we are in the process of finishing all the administrative points and tying up loose ends, but also trying to, what's crucial is that we understand the market that we're entering into and what we will be investing into. To a certain extent, the partner funds are partially invested in a max strategy of some description, and we're transitioning them into our MAC proposal. But we're in the process of trying to understand where we should be positioned from the outset. So identifying where we're at in the cycle is very important for us.
Okay.
So there's a lot of work to go into that. Formulating an investment framework and process, and it's an absolute return product, which is the first within Board of the Coast. So it's a slightly different animal. So there's lots to do, and we're doing lots of stuff. So
okay. It's interesting because you're doing all this stuff, as you put it, during essentially what has been a lockdown. So how easy has it been to do this during lockdown from when you were able to sit down and touch the flesh and look at people in the white of their eyes?
Well, I haven't been to the office yet, so it seems to be working out. There's obviously there's a new norm that will emerge probably later in the year. Okay. So there's some, my personal perspective is that there are some synergies from working from home, that you can get a lot of work done, the detailed work, but you need to be in the office to discuss ideas. I think in our line of work, where you're dealing in information and ideas and trading ideas, and that information transfer is crucial. So there is an element of necessity to be around people on the team to gauge their views and then interact with one another. I think that's crucial. So there's a balance that needs to be struck over the next couple of quarters. So hopefully we get the opportunity to do that.
Yeah, fingers crossed. Yes. Andrew, are your schemes, are they employing max strategies? I think you've left your mic on, Andrew.
You're on mute.
Yeah. Thank you. Technical issue. So for two schemes we're employing multi-asset credit strategies. We've tended to use them as an alternative in sort of the illiquid space.
Okay.
So for one scheme in particular, we were in a queue to invest in real estate towards the end of 2019. And due to the length of time it was taking to invest into that particular asset class, and I think the uncertainties of real estate going through COVID, we changed to move into a max strategy, which is clearly more liquid and is giving a similar sort of return profile, at least for the particular fund that we've invested in. I'm personally, I like MAC because one can, as I think was previously said, it's not a single strategy, so one can look across different asset classes. Clearly, the scheme or the fund that we've invested in tends to be 70% high yield, and there's also quite a lot of a loan product in there, which is shortening duration, which I think is quite good in a inflationary environment at the moment. So far it's been reasonably successful, although credit spreads are clearly very tight.
Okay, thank you, Andrew. I'm sure we'll revisit the inflation issue soon. Tex, how are your schemes using MAC in their portfolios?
Yeah, so I definitely see a sweet spot in terms of size of scheme when it comes to looking at MAC. The very large schemes I work on tend to have individual credit sleeves within the portfolio and tend to do it on more a holistic basis, whereas the sort of medium-sized schemes that do want to access that illiquidity premium, but perhaps want a vehicle and a manager that's going to do that one in a more liquid way, and also have that ability to move around within the credit spectrum on their behalf. So it's definitely the sort of type of scheme that's looking at it. So, similar to Andrew's comments as well, a lot of boards are now starting to turn to inflation and what they do about that. And it's a lot of instruments within that can be cash plus and offer a degree of inflation protection in that way. So that's the main two ways I see schemes using it at the moment.
Thank you very much, Tex. Thank you. Paul, how did multi-asset credit strategies perform in 2020 when we saw such economic upheaval and volatility caused by COVID?
Sure, thanks, Mark. So to be honest, we went into 2020 in somewhat of a Goldilocks period, to use an oft-quoted cliche. Spreads looked relatively tight, volatility was relatively low, but global economies were typically doing okay and moving along. There didn't look a huge catalyst for further spread tightening in our period, but nor did there look to be any sort of major reasons for why there should be a stark underperformance of credit, or in particular and critically a pickup in defaults. Clearly that landscape changed very, very fast, not due to the dreadful surroundings that we saw with the COVID-19 pandemic, but also due to sort of February, March time, also seeing an escalation of tensions between certain oil exporting nations. That, in conjunction with the onset of the COVID-19 pandemic, led to a huge pickup in volatility within markets. Now, as Andrew and Alex have mentioned earlier, there's a huge range of heterogeneity within the multi-asset credit space. However, at that point in time, just such was the unprecedented nature of the crisis, we saw a huge pickup in demand for cash, essentially, clients looking to globally, and all asset classes in the so-called risk spectrum suffered significant mark-to-market losses. Even the ultra safest, in our opinion, AAA CLOs saw aggressive mark-to-market widening in spreads. Now, clearly, as is unfortunately the case with all panics and situations of the transient nature that we saw, those do create opportunities. Towards then the second half of March, we saw large coordinated response from central authorities around the world that helped shore up the capital base. And we often talk in financial markets about, what letter-shaped recovery did we see? I think we probably need to look more to our mathematician trends, because the projection that we've seen in credit from the end of Q1 last year to date has almost been more of a square root-shaped recovery, I would say. We saw a very sharp downturn. We then saw a very sharp recovery in most asset classes, not all. And we're sat today in the position where many of those sectors of the credit market, except for those most directly impacted by COVID, the likes of airlines, the retail, recuperation, leisure sectors, actually now have spreads at or even tighter than we saw in credit markets 18 months ago, before largely anyone had even heard of COVID-19, which I think is staggering to look back and say to people, you would have had, one of the most unprecedented episodes in post-war times, yet 12 months down the line, you'll be at a situation where credit spreads are tighter. And I think that just shows how much support has gone into the markets from the central authorities, and how much cash there has been on the sideline for investors to put to work.
Okay. So thank you, Paula. Tex, just coming back to you briefly. I mean, how easy was it for you to gauge performance of the MAC funds last year in 2020?
So it's quite difficult, actually, because I mean the reason that you go for MAC from a trustee perspective in the first place is because it gives you that additional peace of mind that if markets look a bit choppy, your manager's going to come in and is going to change up your portfolio and move you into the kind of safer areas. That even this kind of boring managers didn't always work, because obviously things like loans were still completely quite hard hit during 2020. And it's very difficult from a trustee perspective to know whether that is an external factor, just a 1 in 20 year event, or whether that is the manager getting something wrong and what they told you was a very kind of safe and boring portfolio isn't actually going to prove to be that safe and boring after all.
Gotcha. Okay. Alex, could we talk expectations with you? I mean, have what clients been expecting from MAC, has that changed in the recent years?
Yeah, it's a really tough one, Mark, because in its simplest form, they still want the return that MAC offers across the credit spectrum, but they also want the diversification as well. And from a pension scheme, that's largely against perhaps their equity portfolio. And they also want the governance solution Tex just talked about in terms of giving that holistic oversight and management. I think looking on both sides, I think from the US client base perspective, they are beginning to diversify more away from US core credit and traditional long only credit. If we look at the yield curve there, the flat treasury yield curve, we can see the credit spread is coming down. And so multi-asset credit lets you get access to other areas, sub-investment grade, emerging market debt, securitized credit, all these flavors that offer that better return. But in the UK, it's very different because there are different reasons for holding multi-asset credit alongside that heterogeneity that we talked about. So for some clients, multi-asset credit just supports the theme of contractual income or long-only income-focused strategies. And we've seen this shift of expectation that your MAC strategy can help support that type of approach. And I think it has also seen a shift in appetite from clients that have maybe become disillusioned or sort of found that the returns from diversified growth funds and the volatility from that has also been waning, also absolute return funds. And they see multi-asset credit as an alternative that can provide attractive returns, or even as a stepping stone, because you can get high quality multi-asset credit, a stepping stone in de-risking or just rotating out of equities to provide some security for short term. So while multi-asset credit, it can be that governance solution for clients that don't have the skill or nimbleness to have the luxury of investing in sleeves that Tex talked about, in the various sectors. It does check the box for clients that also want simplicity. So we have seen some demand for sort of rationalization of more complex portfolio as well. And I think the big change, which started probably just over 2 years ago, but it's really ramped up now, is clients now want to see evidence of responsible investment in their credit strategies. That includes multi-asset credits. and they can't, managers can't simply ignore it. If they do, they're unlikely to get selected. So I think that's a big change that we've seen at the moment. So I'll stop there because I've talked a lot there, but yeah, very varying client demands there, depending on which coast you're on the side of, and what your drivers are.
That's good. Thank you very much, Alex. Andrew, I mean, how have the expectations from MAC for your two schemes that are involved, how have they changed in the past few years?
I think that first of all, it's been a relatively short. We've only been in the MAC product for a relatively short period of time. I think the benefit of MAC and the expectations are exactly as Alex was saying, is that personally I've got a little bit tired of being involved in DGFs. So from a sort of pension trustees perspective, I think lots of pensions are in the DGF environment, which have often failed to perform, sadly. And I think MAC is depending on, clearly there are many different strategies within the MAC asset class, but for those that are a little bit racier, that have more high yield, I think that's an attractive place for schemes to take a little bit more risk in a controlled way, and for but we're relying an awful lot on manager skill within that. So it's we're in a very low rate environment, so it's clearly tricky to get a high degree of returns at the moment.
Okay, thank you very much, Andrew. Philippa, what have you seen in terms of product development in this space? Has there been much happening?
Yeah, so there has, I think, and actually if I had to summarise the main theme and linking back to Alex's comments, I think the big change has been engagement on responsible investment and ESG within, all asset classes, but particularly within the credit space. And as Alex mentioned, clients are expecting more, and it's no longer acceptable to not engage fully on the responsible investment front. And I think in terms of that theme of more, we've seen more managers evolving their existing strategies to incorporate some aspect of sustainability, whether that be via exclusions or better introducing things like ESG scoring into their process. We've also seen more managers coming to market with explicitly responsible labeled products, so going beyond that integration and offering more thematic products, whether it be climate alignment or sustainable development goal alignment, or sort of other themes as well. And I think importantly, that's not just a European story anymore. We're seeing more US managers engaging, which is great to see. And we're really getting to a place now where there is better breadth in fixed income, with strategies that are engaging on responsible investment, which means that we can sort of construct broad max strategies which are really focusing and integrating this stuff properly, without losing out on some of the value generation elements like sector rotation, where maybe historically it was a bit tricky to do that in sustainable credit because strategies were focused more on green bonds or investment grade credit, without that variety that you need to sort of construct proper strategies in this space. One final point I think as well is that we're starting to see, or we've already seen, fee compression. That's not just a sustainable story, that's across the whole market, but I think importantly, it's no longer necessarily acceptable to be seen to be charging higher fees for proper responsible investment incorporation. It's now seen as something that is expected, which is a really positive move, I think, in the market as well.
Thank you very much, Philip, and we will revisit the sustainability issues that you raised later, I'm sure. But could we talk about inflation first? Paul, how are inflationary fears impacting credit strategies?
So as Andrew touched on earlier, there's been some sectors that benefit. We've obviously seen the start of this year was characterized by, a steep sharpening of the underlying interest rate curves, as expectations of some tightenings on the Federal Reserve in particular impacted markets. Now, certain areas of credit markets will, at least be immune, if not benefit from rising interest rates, such as the bank loans market, as Andrew discussed, as well as the more floating rate area, the securitized market, which we think is an oft overlooked allocation, particularly within UK pension funds. However, furthermore to that, it's actually beginning to create a lot more dispersion. You're beginning to see more differentiations in emerging market economies and corporates therein. For example, with the sharp rise in the oil price from literally negative dollars per barrel to touching on $70 per barrel in the recent past, has led to a big impact in differences of finances and risk appetite for countries which are oil exporters versus oil importers within the emerging markets, and many energy related companies therein. However, some of the other conditions actually may be sort of somewhat second order from inflationary, and that has been around the accusation that Federal Reserve and monetary authorities have allowed financial conditions to become too loose. That's enabled a huge amount of corporate bond issuance to come to market post the onset of the crisis last year. And you're now actually looking at a position where expected to see significant large upgrades from high yield, many of which constituents were investment grade when issued, and actually seeing them return back to those major investment grade markets. Expectations are another $200 billion of high yield securities this year could get back to investment grade status. That further, as Andrew says, limits the pool of assets available in that sub-IG space. And in the current environment, we think actually will provide additional support to credit spreads from here, as there's still a lot of investors' cash on the sideline, looking to diversify for many of the reasons that Tex, Andrew, Lloyd, and Alex have discussed earlier today.
Thank you, Paul. Actually, Lloyd, with all this talk about inflation and these fears, is this a good time to be establishing and launching a MAC strategy?
Well, if you look at it from a cycle perspective, that's one of the strengths of MAC. You have a broad enough opportunity set. You have enough levers to pull to, let's say, smooth your returns through a cycle. There will be weaker environments and stronger environments, and you won't fully sidestep all negative returns, but you have the tools at your disposal to properly manage your fund through a cycle.
Okay.
So it has that benefit, and that's why investors like MAC.
Thank you very much. Tex, are you worried about inflation?
Yeah, I think all schemes are turning their attention to inflation to one degree or another. The larger schemes are obviously fully hedged through their LDI portfolios, but there's still a concern that your credit mandate is going to underperform unless it's got a large allocation to something that's floating in there, which again comes back to that, can I delegate that part of the portfolio, that bit of governance to an investment manager? So going back to a point that Philippa made earlier, though, a lot of my schemes are really focusing in on ESG and climate change in particular. Okay. And I think that's a real challenge because it's a point that Alex made. All the investment managers are now very well aware that they're not going to get appointed unless they can demonstrate their credentials in this area. So every single one will tell you that they're doing an excellent job in this area and list off various things. And I think from a trustee perspective, it's incredibly difficult to see which of those are genuine and which is just been generated in the marketing team. So I was actually going to ask Philippa and Lloyd how they get around some of those challenges.
Okay, Philippa, would you like to go first?
Yeah, sure. I mean, I'm going to sort of cheat, I guess, on my answer and say we rely heavily on Paul and his team in assessing managers and making sure that they are doing what they say they're doing. So we have a framework that we work to when we are looking at building portfolios. And one of the explicit parts of our framework is incorporating our research team's assessment of ESG, and we can only invest in managers which meet the standard that we think is acceptable. And Paul and his team have done the research and actually landed on that. So maybe Paul's better placed to talk about kind of the specific factors that they look at when they're looking to avoid, I guess, greenwashing or not doing what you say you're doing on the tin.
Okay, Paul, over to you. What do you look for when looking to avoid greenwashing?
Yeah, thanks, Philip and Tegs. I definitely agree with you, and that is something that we are assessing as a enormous challenge. There's a few aspects that we've taken to try and mitigate that risk. So one, as Philippa says, is just the good old-fashioned rolling your sleeves up and getting very heavily integrated with the managers themselves and discussing all considerations that matter to RI and ESG. There's the talking with the analysts, talking with the fund managers, going through examples, seeing those engagement records in detail, and actually being able to get credible evidence, positively and negatively, where the managers have changed positions due to RI considerations. Mm-hmm. Another part of it, I think, and it comes back to the old adage of, what gets measured gets done, is actually trying to have explicit KPIs in place with managers. One way we've particularly found doing that recently is we've actually worked with several of the larger managers to actually cornerstone and create and seed some of the vehicles that they are establishing. And as part of that product development process, we've been heavily involved as Aon in helping shape those recommendations and putting procedures in place, which in our opinion, prevent the ability for those managers to greenwash by having credible, sensible targets, and critically, ways of being able to assess the managers on those, which I think segues into a couple of later questions on the agenda. But Philippa, sorry, I see you raised your hand.
Yeah, I was just going to add to that as well. Off the back of what Paul said, it's very much not a one-off assessment. I think is important as well, because things are changing so quickly in this space, and the pressure on managers means they are actually improving. So I think the ongoing monitoring and engagement piece is really important. And we have a formal engagement program. We get our managers to fill out an extensive ESG due diligence questionnaire every year, and then we have meetings with them to discuss the answers to that and kind of set them with goals and have touch points where we follow up. And I think that process is invaluable for, it's much easier or much more difficult for a manager to say they're doing something and not do it on a one-off meeting than it is to turn up every 6 months and be grilled on it, and that sort of brings things out in the wash.
Thank you. Lloyd, how does this differ from how you sit down with someone and you decide if they are walking the walk or talking the talk when it comes to these sort of issues? Because everyone's talking about it, but it's very difficult to do.
Yeah. Well, we obviously do have an internally dedicated team for ESG, and they support us extensively. And the ESG process is fully integrated to Border to Coast. Our partner funds are extremely keen on us managing the ESG process correctly and monitoring it. So there's a situation where, of course, when we are selecting managers, we will look at their broad ESG capabilities, not just at the MAC level, but we think we can leverage other asset classes as well. So that's an important factor when selecting funds for us. So in addition to that, we're actually seeing quite encouraging signs because it's so in demand from investors. We're seeing encouraging signs even in difficult asset classes like credit, where you have difficult structures, beneficial ownership is slightly different and intricate. We're seeing our managers really endeavor to make progress in mapping certain traits in their investment processes. So what we've seen has been really positive. There's still a long way to go, right? But for us to get up to speed with the equity world, there's quite a bit of work to be done. But we're traveling in the correct direction.
Okay, good. And Philippa, is there something you want to add?
No, I didn't have anything to add.
I'll just put your hand up there, no problem. Okay, Andrew, in general, when you're assessing managers for MAC funds, what sort of process do you go through to ensure you're backing the right person?
we rely quite heavily, I think, on the investment advisors. It's as a trustee, it's impossible to know all the different managers that are out there.
Mm-hmm.
I think going back to the sort of ESG comments, clearly in the credit space, ESG has been relatively slow to take off in comparison to the equity world. I think it's fair to say, which is surprising because in some respects, as a bondholder, you have more power talking to the finance director of companies than you do if you're a shareholder. So, you know, it could clearly be argued that I think that credit funds have more ESG power in many respects in terms of changing and understanding what the underlying companies are doing. In terms of actually choosing, to be frank, it's looking at portfolios, it's speaking to the managers. Do they understand the risks that they are taking? Do they have the ability, if there are credit crises, what is their experience in terms of workout? You know, whenever you talk to an asset manager, all of them are fantastic at selling their story. What always concerns me is what happens when something goes wrong, because something always goes wrong. And I'm also interested in, because MAC is clearly a diversified portfolio, what are their experiences in the different credit asset classes, and also the different jurisdictions and currencies that they come in. So how are they hedging that back into sterling? Because we're obviously, we've got a sterling asset from our perspective, but if you're buying dollar bonds or, you know, Hong Kong dollar bonds, whatever, how are they hedging that back, and are they doing that in a sensible way? So we try and look at things. We try to challenge fund managers as much as we possibly can, but at the end of the day, we're not credit experts as trustees.
Interesting what you said there, Andrew. Tex, do you agree that credit strategies have more power when it comes to ESG? Is that something you're experiencing?
Yeah, I do actually. I think historically a lot of attention around engagement has been focused on voting and what your manager's doing for you in that space. But in reality, that has sort of limited impact. And it's those, like Andrew said, it's those repeated conversations when FDs are coming to market, you know, every 3 years, every 5 years, however often it is, to raise their finance that really can influence companies' behaviour. And I think, interestingly, what I'm seeing more of now, I've seen 2 examples of this in the last year, is FDs getting a cheaper cost of capital when they can demonstrate they're hitting ESG goals. And that's really helping moving the conversation forward, because everybody is kind of aware of the importance of this, and FDs themselves are really keen to demonstrate what they're doing. So I think it's all starting to fit together a little bit.
That's great. Okay. And Lloyd, how easy is it to get ESG into a MAC fund?
There's a lot of work that's been that's been done on the technical integration over the last couple of years. It's becoming slightly easier, but as we mentioned earlier, it's a problematic asset class. So it's not as easy as getting it into equity. Not to say that it's impossible. It's very plausible to integrate ESG. We just need buy-in, like true buy-in from all the managers, not greenwashing, not pretend. But look, to Teg's point, that if you're gaining a cheaper cost of capital, that is the largest incentive you can provide to a company. So soon, it's going to be easier, it's going to be more straightforward, and it's evolving in the correct direction.
That's great. Thanks for that, Lloyd. Thank you. Philippa, how are you seeing that MAC funds are making positive social and environmental impacts? In what way?
Yeah, so I think there are a lot of different ways that this is being approached by managers. I think as a starting point, you're seeing managers really working to make sure that they are properly integrating ESG and RI considerations in their process. So scoring securities, doing much more engagement with companies, and all of those things. So I think that's happening in a fairly broad way. But what we're also seeing is a lot of managers actually taking an additional step and either restructuring or launching products to be explicitly sustainable. And the two main themes that I'm kind of seeing here are that the credit strategies particularly tend to either be climate aligned, so investing in green bonds, unlabeled green bonds, kind of climate leaders within industries, or UN Sustainable Development Goal aligned. Those seem to be the two kind of key areas where managers are actually being able to demonstrate that they're doing this and doing it in a sensible way, rather than greenwashing. And certainly that's the approach that we're taking within our own MAC fund, because that is where we've identified, with help of Paul and his team, that there are managers managing high conviction MAC funds which can generate value and also deliver on those kind of sustainability objectives.
Good. Okay. Thank you very much for that, Philippa. Paul, in your opinion, what changes do mainstream MAC strategies have to make to be more sustainable?
Yeah, so Philip has touched on some of those aspects there as to what we're seeing.
Yeah.
But we are definitely seeing that movement and evolution. You know, as Lloyd, Andrew, and Tex have said, you know, we're somewhere behind the equity space, but we are definitely moving in the right direction. You know, we are beginning to see, as we've discussed, you know, integrating ESG as a financial risk is now pretty much a taken for granted as a necessity and a requirement. Again, we've moved on again from ESG strategies purely being about exclusionary, you know, the so-called sin factors, and moving now on to actually that positive ESG engagement and our engagement to lead to those sustainability factors. As Tex has said, we've started to see more corporate issuers come to the market with sustainability linked KPIs, measurable, sensible, tangible, you know, unequivocal goals that impact the cost of capital in a positive way, should that issuing entity be able to achieve that. What's then critical for the managers to evidence that and to make them more sustainable is to show those commitments to those approaches. The fixed income market is again somewhere behind that of our equity colleagues in terms of actual ESG and RI specific benchmarks. But again, there in recent past, we've seen huge amount of development and some exciting sort of Paris climate aligned benchmarks coming into place in the fixed income marketplace. This gives a far more, you know, evidence and chance to be able to interrogate those fixed income managers. And going back to that adage of what gets measured gets done, is by being able to have those managers report in a pragmatic way on their achievements, rather than just simply saying, look, we're a low carbon strategy and we've reduced carbon by 20% versus a benchmark. That's very simple to do. You only need to exclude a very small proportion of the issuers in the benchmark to have an enormous impact on the carbon footprint of a portfolio. And secondly, with all due respect, it's quite a naive decarbonisation process that might help today. But as Philippa said, we want to see that evolution and the commitment to, you know, whether it's a climate specific strategy and the achievement of net zero and that pathway, you know, by 2030, 2050 and other milestones to achieving it. So it is about engaging more, without the pun, with the investor community, showing more of that evidence, more of that reporting, and simply being made more accountable by being able to evidence these decisions and reporting of the funds in a comparable way across strategies and managers, so that investors can make an informed decision.
Thank you, Paul. Alex, it's all very well with these strategies making a positive impact, but how exactly is it to measure, to actually gauge the impact environmentally or socially that they've made?
Yeah. So in short, Mark, it's really hard. And I think Andrew and Tex have touched on it, that you need that oversight and expertise, you know, from somebody that has rolled up their sleeves and got stuck in with the manager. But I think, you know, ultimately clients want to see evidence from that reporting that Paul talked about. And if we want to report consistently across the industry, we need good data quality. And I'd say that the data quality just isn't there yet. It's evolving, it's improving, but it's got a long way to go. And also in that data as well, not all aspects of sustainability are captured. A lot of the data is even assumption driven, and so it's not particularly robust. So different data providers will give you very different information depending on who you use. And if I think of one example of a very well-known global provider, a very well-known utility company, there is one score for that entity. So if you have a 2-year bond, a 30-year bond, a 10-year non-conforming bond, a green bond, you get one score regardless of how you've invested in that credit. And so that's really hard to look through and analyze from a pure data reporting perspective. And I think, again, we've talked about sustainability, we've talked about ESG, but investors are looking at both of these through different lenses. So for some investors, they will have a climate metric focus, like the Paris Alignment Agreement, but some might focus on sustainable development goals as well. And so reporting in each of these is, the data needs to improve, but it's just patchy. And I think in credit, it will improve, and it's in its infancy. Clients do need some patience here, but back to that key point, if you don't report it, it doesn't get done. So I think we just need to keep pushing and keep engaging.
Thank you, Alex. Interesting point you made there, Lloyd. I mean, what do you think about the quality of data and these scores where you get a single score? I mean, how much value do you put on those?
Look, it's exactly correct what Alex says. The data is fallible, but it's improving. It's not a perfect science just yet, but it's moving in that direction. It's that progression which is important. As I said earlier, there's many examples of good work being done by the managers. They're trying to digest it as well. I used to work for a DGF fund, and it's difficult to digest that instantaneously to reflect the demand of the investor. It takes time, and it takes a large amount of resource. So it's understandable that this is a progressive process, and it's not binary. It's not, you can't turn it on and off. It will take time, and it does need to improve. That's an agreed upon point, but and you can't read too much into it, but with time they will become better.
Yes, companies will be better at providing more uniform or volunteering more uniformed information, I'm sure. Thank you. Before we moved on to the whole ESG thing, I wanted to ask you, Andrew, about inflation. And we never got round to you. I mean, is this something you're discussing with your managers?
I think it's not something we're specifically discussing with the managers. We are within the trustee committee, within the IC committees that I'm on or I chair. Most of them, we're in a lucky position that we are significantly hedged. So inflation is not too much of a concern. The real concern is just on the returns. Obviously, what the real returns are of the assets that we're getting, that we're investing in. So that is important to us, and it's something that we're looking at. But in terms of the overall portfolio, it's relatively minor, I would say, these days, because certainly in the portfolios I'm involved in, we probably hedged 5-10 years ago, so it's not so much of an issue. I just wanted to come back on one thing on the ESG side of things.
Of course.
If I may, I don't buy into the fact that it's harder within the credit sphere, insofar as the number of bonds that are available in the market are much more limited. The credit market, obviously, the fixed income market is significantly larger than the equity market, but the number of issuers is actually significantly smaller. So the majority of fund managers are probably playing in a pool, and Philippa, you know better than I do, but it's probably in the order of 1,000 to 2,000 credits. It's not a significant pool. The other thing that I think is people perhaps are not aware of, green bonds were first developed 10 years ago, 15 years ago, something of that order. And the reality was that green bonds really were just a marketing tool at that time. And I think the world, the good news is the world has moved on. And personally, I'm not particularly bothered whether a manager invests in a green bond or a non-green bond from the same issuer. So green bonds were issued because normally they could get the origination away 1 to 2 basis points cheaper. So it was from the FD's perspective, it was a huge benefit. Now I think, and again, I don't have a Bloomberg terminal, so I don't know the different spreads between green bonds and regular bonds for the same issuer. But I'm relatively indifferent if the manager picks a green bond or a non-green bond of the same issuer. What I'm interested in is getting the higher return. And I'm interested in the fact that there's real engagement with the finance director from an ESG perspective. That's really what I'm interested in. Whether a bond is green or not, I still think, and I'm happy to be proved wrong, is just still a little bit of a marketing tool.
Okay. Thank you for that, Andrew. Philippa.
Yes, I think that's a good point, and I think I'd agree with everything you say. And I think coming back to the themes that we're seeing in terms of what's coming to market and how managers are approaching this is that it has moved on from a green bond strategy, and a lot of even the very climate aligned or climate focused strategies are almost, as you said, indifferent between green bonds and what they're calling unlabeled green bonds and climate leaders. So you're really getting this broader approach where managers are doing very good engagement with companies and actually getting really impressive commitments in terms of business transformation because they've got that close relationship with finance directors and so on, and also investing across the non-green bonds and looking more at kind of what the company is doing and how those proceeds are used rather than any sort of labeling for marketing purposes.
Great. Thank you, Philippa. And Tex.
I just wanted to actually come back on the sort of investors need to be patient point around data and ESG, and say that actually I would challenge that. I've seen the best success where I've been the opposite of patient, albeit in the buy and maintain space rather than MAC. But when sort of asking managers to break down their portfolio across various different criteria, the initial response on the first round is, we don't have that data, it's not available. When you go back to them with the response, find that data or I'll fire you, it's amazing how quickly you can get full disclosure on things like that and really sort of focus people's minds. So I would encourage investors to be anything other than patient on this.
Okay.
I would totally agree.
And Philippa, are you patient?
Well, we're not patient, and a lot of the engagement work that we do through our engagement program is about data and transparency and reporting, because that's critical not just to myself and Paul and his team to assess managers, but also to clients because they need to know what's going on. But I think there's a trade-off in terms of we can be as impatient as we like and push managers to give us information, and they do, as you say, Tex, give us good information. But I think the challenge, and this is maybe what Lloyd was referring to, comes from different managers will give different data and assess in different ways because it is inherently subjective, because we don't have those kind of really good solid data sets through mainstream providers that all managers are comfortable with, and because the managers are taking that extra step and looking at things in their own way, they often disagree with some of the data providers. So it's hard when you're looking across a spectrum to get a consistent picture, even though our underlying managers will be very responsive with giving data when we ask them. It just isn't cookie cutter, I think. So there's maybe kind of both aspects there. We need to be patient for consistency and impatient for transparency and providing what can be provided in the meantime.
Okay, I'm pretty sure we could talk about ESG all day, but the time is pressing, and I'd just like to end now by just going to looking a little bit into the future and what some of you guys think. Lloyd, could we start with you? I mean, what are you expecting to see in the multi-asset credit space in the next 12 months, say?
I like to frame it using cyclical analysis. and just try to understand the background, then to put it into identify where we are in the cycle. So ultimately, the background of supportive monetary policy, that's not going away. Default rates are low. And corporate earnings are good. Okay, I caveat this with like rich valuations. If you look at the covenants, they're kind of issuer favorable. These are signs of late cycle. So ultimately, what you have to take from that is returns shouldn't be stellar given the backdrop. We're kind of late cycle, so returns should be single digits, mid to low single digits, taken majority through carry. It's difficult to see where you get additional capital appreciation. There are some opportunity within the MAC opportunity set. There are some pockets of value, but there's very few compared to the last 6 to 12 months. That's the base case. Okay, what can challenge that base case? A resurgence of the virus, of course, is what we're seeing now. It's challenging the growth outlook, the global growth outlook. Inflation, although it tends to be, it's not a bigger threat as it was probably 2 months ago, 3 months ago. But is it persistent? Is it transitory? That's one question that's been posed to the market. Transitory has been interpreted by the market, as we can tell by global yields. If that were to change, funding rates go up. That then puts companies under pressure. Risk assets could also be under pressure, and then we're in a higher vol regime. So that would then challenge the base case that I just outlined, and possibly you'd have lower returns. But as I touched on earlier, MAC has a few levers to pull on to take you through that cycle, whether or not you up your duration or whatever's appropriate.
Okay. Lloyd, thank you very much there. And Tex, what do you expect to see in the next 12 months?
I think from an investor perspective, I think the demand for MAC might actually be quite limited over the next 12 months. And I say that for two reasons. One, because, the point that Lloyd made around we are being, we are late cycle. So the return prospects aren't potentially what they were. And the second one being, I think a lot of people that went to MAC at the other end of the spectrum, the sort of low and boring, I want, a couple of percent over cash a year, every year, were quite shocked through 2020 when their product sort of didn't deliver that. So I think from it, I don't expect a huge amount of investor demand.
Interesting. And Andrew, same question to you. What are your thoughts on the future?
Clearly there's been huge fiscal and monetary stimulus, as already been mentioned, and clearly I think we are a late cycle. And I would tend to agree with Tegs that there will probably be less investor demand over the coming 12 to 18 months. However, I do think that the MAC product is a good product. There's the ability of the manager to adjust duration, adjust the underlying credits that are within the portfolio, so that they hopefully, if you have the right manager, they can ride the issues out that inevitably will happen over the next 12 or 18 months.
Good, Richard. Thank you very much, Andrew. And finally, I think out of the guys from Aon, Alex, could I ask you to give me your thoughts on what you're expecting to see in this market in the next 12 months?
Yeah, I agree with Lloyd's comments in part, and I'll challenge Tex's comments a little bit just to make it interesting. We've talked about RI and ESG, but I think, in the current environment, I think we're all in violent agreement that corporate bond valuations are expensive. There are some big buyers out there, namely the Fed and the ECB, that are just pushing credit spreads lower. What we're missing, though, I think, is that dispersion across the credit sectors that is prevailing, and therefore investors would like to take advantage of that where MAC strategies can do that. And so there's also another theme that investors that have been holding on to equities and you know, survived the gyrations in the market might want to de-risk and rotate into something like multi-asset credit to crystallize those gains and give something a more diversified approach. What I would say from a sort of demand side from clients is that what we can see from even introducing RI strategies, but even looking at that boring strategy that Tex talked about, is there will be style biases. And what I've seen and what I expect to see going forward are clients wanting to put different MAC managers together, so getting complementary styles to just improve that diversification. So a multi-manager approach has actually been seen to be more robust, especially because, you know, regardless of how broad the manager is, there will be biases in how they manage the portfolios. So I think there will be demand. I think there are reasons to still go into MAC. And I think just looking at valuations in absolute terms is missing that dispersion, and the fact that in any single year, the dispersion of returns between sectors can be mid-single digits. And so MAC managers can take advantage of that.
Thank you, Alex. And unless Paul or Philip have anything to add to what we've just heard?
Not for me, thank you, Mark.
Okay, guys, thank you very much for this. This has been great. I've learned plenty there, so thank you. I'd like to thank Lloyd, Paul, Alex, Tex, Philippa and Andrew. Thank you for joining me today, for sharing your thoughts on the market. I would also especially like to thank Aon, our sponsor, for making this discussion possible. So thank you and goodbye.
Thank you, everyone.
Thanks,
Bye-bye.
everyone.
Thank you, everybody.